Thank you for signing on to the Family Office and Petiole Asset Management webinar on real estate credit. My name is Hani Abouali, and I'm the CEO of Petiole Asset Management. Given the recent rise in 10-year rates and investors fearful of inflation for the first time in decades, the questions on people's minds have been, what assets fare well in such an environment? How do you play in this space? And how can investors protect their capital? And there's no better person to address these important topics, in my opinion, than Alex Popov, who is the head of illiquid credit strategies at Carlyle. Alex, who's our guest here on this webinar, has decades of experience in illiquid credit investing. Illiquid credit is one of the three main pillars that make up Carlyle's $56 billion global credit platform, which also includes liquid credit and real assets credit. Prior to joining Carlyle, Alex was a managing director at HPS Investment Partners, also known previously as Highbridge Principal Strategies, from 2008 to 2016. At HPS, he founded and led the firm's real estate credit platform and served as a member of the board and investment committee of the joint venture between HPS and the related companies. Before joining HPS in 2008, Alex worked at Oaktree Capital, American Capital Strategies, and Donaldson Lufkin Jenrette, where I also worked in the 1990s. The Family Office and Petiole have been investing alongside Carlyle and Alex specifically for many years to help capture and exploit illiquid credit dislocations, primarily in the US, but also in Europe. There's a lot of ground to cover, so we will focus on the three main areas in this webinar. Number one, the current macro environment and Carlyle's views. Secondly, the impact on the various real estate subsectors. And third, experience and lessons learned that Alex can share with us for many years of investing in this space. So Alex is going to cover these main topics with some of my questions, and then we're going to open up for a Q&A. And this is meant to be an interactive session, so please feel free to post your questions on the menu, and then as we get those questions, we'll roll through it. So Alex, maybe we start with you, and maybe the first simple question is, we've seen a rise recently this year in treasury yields. Why is this happening in your view? And what does that mean, in your opinion, on asset classes? What tends to fare well in such an environment?
Thank you, Hani, and good morning, good afternoon, everyone. Thank you for the nice introduction. And I'm very excited to be here and have this conversation with everyone. So, maybe starting with this first question about, look, 10-year rates have spiked up recently, and there's been a lot of conversations on investors fearful of inflation. I've heard the phrase used for the first time in decades. Maybe to start with some sort of grounding, this is not the first time this is happening, and over the last decade, we've had at least 3 to 4 times where the economies and market sentiments has gone through periods where market exhibited serious concerns with inflation and higher rates. Essentially, we have been worried about this periodically over the last, 10, 12 years. First, it was 2010, 2011. Plenty of headlines tied to QE after the great financial crisis. Metals, oil prices surged in the aftermath. Then there was 2013, taper tantrum, same thing. Then there was most recently 2018 when the Fed was raising rates and oil was near 70. So in other words, investors just regularly fret over inflation and rising interest rates in big part as a consequence of accommodative monetary policies in the aftermath of the great financial crisis through today. I'll flip quickly to this slide 7. Today, the 10-year has found a range that feels more comfortable. After the elections in the United States, particularly after the Georgia elections, the 10-year Treasury was sub 1%. And the rise since then has been meaningful, and it has moved fast. That's how the market adjusts. The other thing that this slide also shows, and it does have a risk component adjusted to it, but is the notion that I went through just now, is that over the last decade, there have been a number of times that this has happened, where the demand for real compensation for this risk tied to inflation has increased. You can see obviously what happened in 2018. Where the risk-adjusted ratio was on a Sharpe ratio was close to 1. So this is not a new thing, and we're going through this again for a reason. So I'll go through to slide 8 first to say where we are today. U.S. given the move over the last 2-3 months, U.S. yields and treasuries have started to look attractive to foreign capital pools again. The 10-year yield on a currency hedge basis is at a 5-year high to Japanese and Euro investors, which in turn creates demand from foreign investors. And as a result, if you look at the next slide, the treasury sell-off over the last few weeks has moderated. Interestingly, though, so we've just talked about a little bit of the compensation for the risk and market dynamics. But if you focus on the underlying reason for the increase in rates and forward expectation for inflation, this is an interesting representation, and economists fairly often use, is focusing on the neutral rate. The implication of this chart is that the increase in forward rates really are associated with real rate increase rather than inflation expectation. There has been a 90 bips of real rate risk rate increase, and that is virtually all of the increase in neutral market rates. So while the market is worrying about inflation, I think the underlying thesis there is that the market had sold off quite meaningfully in credit and needed to readjust to find a new fair compensation, and that's what's been happening over the last few months. But let's talk about inflation, Hani. I think that's where you started with the question. We cannot completely dismiss it. Inflation expectations have gone up. As the 10-year had risen from 2 to 2.35%, and currently the 10-year sits at a level not seen since 2013. This is driven by inflationary expectation in industries that have seen meaningful supply constraints because of the pandemic. Supply came out, demand came back faster. Shipping, transportation, logistics, plastics. There has been a multiple increase in cost of these items, and there is clearly a concern that can flow through in the economy and cause runaway inflation. However, there are strong mitigants to that. Importantly, we're barely back to a years ago level of GDP. Talking about the US, but it probably applies to most economies out there. Massive decline in employment still persists. Payroll is still down. There is a lot of unused capacity in the industry. And then importantly, big part of the economy today, particularly with the changes caused by the pandemic, come from the digitalized world where capacity is really not an issue. So as a result, we have a number of competing dynamics here that balance off, I think, and moderate some of the fears of inflation in the markets. I think, further policy changes and economic developments are going to be key to what investors think and feel about inflation and interest rates going forward.
So Alex, just maybe staying on this slide, which is really interesting. So you're less worried about inflationary risk here, but we're talking about real rates, the reflection on real rates. So what does that actually mean to your typical investor? How do you think about that? What asset classes tend to fare better in this type of environment when real rates are rising?
Look, I will focus on investors in the real estate asset class specifically. Obviously, there are a lot of different potential expectations, but I think this is an environment that, first and foremost, fundamentals become a lot more relevant. And investors should really focus on particularly investing in credit in real assets is on probabilities of default, value that they're getting for the risk. In addition, big part of real estate debt is fixed coupon. So obviously, if you have concerns with runaway inflation, that locking for long-term debt exposure at fixed rate is problematic. But let's take the first one in more detail. Fundamental risk. I think investors today need to ask the question, is the asset class undergoing transitional change or structural change due to the events of 2020? It is certainly would appear that changes for real estate investors are more pronounced, during this pandemic than ever. One of the key characteristics of real estate has always been that supply adjusts slowly and is capital intensive. When capital is abundant, supply is created in anticipation of demand. Demand, however, can adjust sometimes overnight and create quite massive supply-demand imbalances. And the aftermath of the pandemic in 2020 has created those imbalances. You have residential real estate and logistics seem to be in almost sustained undersupply of assets and consequentially attracting a lot of capital and lower yields. While you have other asset classes such as office and hotel that are trying to figure out, is this a transitional change or is it a structural change in those markets? And capital is a little more reticent to go into those areas. Retail has had some serious issues before the pandemic, and certainly that's not been improved because of what's happening. So I think the key question for investors today, frankly, it's always, but more so pronounced today, is focusing on the asset class, the particular asset class, the changes that are happening within the asset class, and answering the question if it's transitional or structural change.
And so where do you see, at least in your space, the transitional versus the structural, the biggest shifts that you've seen post-COVID? Because I know you've written about this also on the transitional changes.
Right.
It'd be interesting to hear you share with us your views on those subsectors, please.
Yeah. So, look, I think there are, I touched a little bit upon this just now. I think there are asset classes such as residential and logistic asset classes that have been the big beneficiaries of, frankly, decade-long demographic and technological changes that have been massively accelerated by the last, the events of the last 12 months. Capital is certainly favoring today this type of assets and is flowing more willingly to these asset classes. Office and hotel are in that uncertain mode. Is it transitional or is it fundamental change? We will probably know the answer to the question in hotels a little sooner than the office. As the economies and markets are starting, we see sort of the vaccination programs and return to normal in some countries are certainly giving a sense to what's possible. The fact that there is a significant pent-up demand for travel and leisure experiences. We track some statistics for various markets, but New York has had a significant and pronounced increase in hotel occupancy and ADR over the last 8 weeks in a quite sustainable manner for the first time since the beginning of the recession, of the COVID crisis. So I think the question on the hotel market will be answered, and there will be more information to that in more near future. The changes to the work environment, and particularly linked to the office market, which sees usually much longer contracts and commitments from tenants, are probably going to be slower to manifest themselves, and certainly more risk, but certainly the opportunities there. And in terms of where capital flows today, right? Capital flows to the asset classes with better supply-demand dynamics, and also in any dislocation, capital providers are drawn to less risk. And it creates, as a result, similarly demand supply. There is more capital for senior part of the debt stack, less demand for the junior part of the debt stack in times of dislocation. And then there is less demand for more challenged asset classes. But that in turn creates opportunity. So the areas, if one is looking for stable yield, I think there's probably less value there, but good focus on downside protection. If one is looking to find differentiated yield, there is plenty of opportunity today. Obviously, it comes with the risk.
Fascinating. And so when you look at your portfolio and you're looking at your pipeline, what sort of things appeal to you when you're thinking about maybe being opportunistic in this environment as a credit investor? I'd be very curious to know, Alex, how you think about also pricing that risk in this environment.
Yeah. Look, I will go back to I think the most important question for investors today in real estate, but frankly in most asset classes is to decide, do you want to reduce risk and ride the change in the market with lower return? And many investors are taking that path, which reduces obviously absolute returns, and relative value, I would argue, is diminishing. Or selectively take opportunities that are presented in the market, and find the value in the less active markets from capital perspective, and more riskier positions. Now, obviously, this is a challenging proposition, but the key question there to answer is this asset, is this industry going through a transition or a structural change? Where we find in our pipeline that we gravitate to is the transitional investing with some meaningful layer of complexity. So not as necessarily assets that squarely fit within one particular grouping. Maybe there is asset has an exposure to two different submarkets, whether it's leisure and office, or it's a more unique asset within that space. So complexity that doesn't easily slot an asset into a grouping, combined with a transitional aspect, typically offers really meaningful value. And when I say that, I think the marketing generally is sort of rewarding that risk. We've all seen rates in corporate credit as well as in more senior debt go down to sort of almost all-time lows in terms of the spread and the compensation for the risk. I think an investor can, if they find the right opportunity in transitional asset with complexity, they can earn somewhere between 5 to 7 and even more percentage points of return premium in credit that is quite meaningful.
And can you give maybe just anecdotal evidence of this, or examples of particular? You mentioned lodging, for example, and you mentioned the pickup in traffic and tourism in New York. sure you follow other trends on, elsewhere. It'd be interesting to know, without naming names, but feel free to kind of share with us anecdotally what type of asset would appeal when you're talking about that kind of spread.
The key word there that I was using really is transitional and complexity. And the examples that we can give is companies and asset-heavy companies. So, for example, home builders. Home builders that are in the right market, meaning residential is undergoing chronic undersupply pretty much everywhere in the world. However, the structures of these businesses, the capital intensity, and the need to underwrite that years forward does create that level of opportunity. So that's one area that we are exploring. Other areas that are of interest are the more niche asset classes. Again, the ones that I mentioned do not fit neatly in a particular segment. Some of them are too niche to even mention because there's probably one or two of this type of assets around. But some of them provide, to give a few examples, just nothing in specific, but assets in infrastructure for marinas, leisure assets that are not neither hotels, which are like venues, or leisure venues, entertainment venues, or others. So real assets that have been affected from the pandemic in a transitional way are expected to recover given what we see, given consumer behavior, and are in need of capital today to bridge them through the transition period and possibly actually capitalize on the opportunities that they see, whether it's making acquisitions in that segment, one business acquiring another, or expanding its footprint.
Fantastic. I think, just for the benefit of the audience, what I love about Alex is that he goes into niche areas as well as areas of dislocation that wouldn't naturally be available for a common investor. And I don't think he's trying to avoid my question, but things like assets in transition that are a sub-segment, whether it's a marina or a venue or what have you, it's really fascinating that those types of assets are also priced separately from, say, the parent, whether it's a part of an office building or a hotel or what have you. And that's what you're able to crack, which is quite unusual relative to other investors that we've worked with over many, many years. And I think that's really fascinating. But that's what you're saying. Dislocations create that opportunity in those subsegments. I'm curious to know, Alex, maybe taking a different view on, over many years, you've also got some battle scars, and curious to know what are lessons learned or things to avoid as a credit investor in real estate, particularly in this environment where you practice that type of discipline. It'd be wonderful for you to share those insights with us.
Yeah. Well, certainly this is a question we can talk about for quite a while. Look, I think the first and foremost, and this is probably the obvious one for everyone, real estate is not a monolithic asset class. And market changes, economic downturns, other crises have a different outcome and different impact on these asset classes. The one thing that people generally worry about in real estate, though, in aftermath of past downturns and low interest rate environment, is the corollary to your question about inflation and interest rates. We have been in very low cap rate environment for a very long time. And people consistently worry that a reversion to longer term cap rates is going to negatively affect downside protection, valuations in real estate, et cetera. The one thing we've seen, though, again and again, and look, history is long, so we may not have looked far enough, but is that, look, cap rates are originally, they depend on, the 10-year yield. They depend on the risk premium, but they also depend on what's in the economy. And if you look at historical reactions in cap rates, they actually behave inversely related in many cases to interest rates. So the last time we saw a meaningful spike in cap rates was in 2009, 2010, when interest rates were declining meaningfully. We obviously saw a not small, pronounced, but short cap rate increase in the early days of the crisis. Again, during a period of interest rates being reduced. I think that the key part there from a cap rate perspective is that there is a meaningful spread between cap rates and interest rates, and that spread actually fluctuates based on risk and fundamentals. So when there is growth and when interest rates in the market go higher, that spread typically narrows because of better expectations for growth and ability for assets to navigate higher interest rate environment. So, and then inversely, when interest rates go down, typically economic environment is not great and spreads widen. So as a result, we've actually seen a pretty, relatively stable cap rate environment. And given the level of compensation in other asset classes, it's hard to see a meaningful move in cap rates, at least in the near future, to the upside. But again, that's, I think, is a framing question in terms of people ask me a lot for this market, if that's something we're concerned about. The other part is, and I think, Hani, you and I talked a little bit about it, is the capital that has come into the market over the last 10 years, and of course more recently, has smoothed cycles, particularly for distress. It's hard to say that there are no distress opportunities right now in the market, because there's clearly properties that are overlevered because of the last 12 months, and where the supply of capital is not as willing to come in. However, with that said, I think investors are by and large being patient. If opportunities that are relatively on the sell side, investors are being patient. They're looking through this cycle and are not panicking. And from a perspective of new capital, there's just pretty good amounts of capital have been created that do not allow those spreads to really gap out. So again, this is not to say that there aren't opportunities. There's certainly opportunities, but the market is on the sell side and the resolution side is being patient about it. So that distress opportunity is not materializing as fast as people thought it would.
Are you surprised about that, given where we are today, say, versus 6 months ago or a year ago?
Look, it is the patience of existing equity and debt owners is frankly been formidable. There is certainly a case. Look, we all are seeing that this was a significant one-year dislocation in most asset classes, there will be longer-term consequences in others. So I think that's what the market is trying to parse out. Is this a transitional change and a permanent resolution is not needed? Or is this a more fundamental structural change and a restructuring and new capital is going to be needed? And that, look, I think that's to come. That distinction between the two, when it becomes more pronounced, you will start seeing more activity.
Good. I'm just going to pause there for a minute and let folks put in their questions. There is a menu in your in front of you where you can enter your questions here. I'm getting a couple already. While we get new questions in, I'm also curious, just back to my earlier question on sort of enduring lessons learned. What are things that you'd avoid in this environment that you think may be worth sharing with folks on the call?
This is my personal opinion here, and I think it's going to be very broad. This crisis, because of the potential that some asset classes are going to be structurally changed, is not one of those that you can just weather through time. I think there are structural changes in the market for real estate, in the market for credit, and different corporate businesses that the statement of real estate always comes back. While it may be certainly true for majority asset class, is not going to be true for every asset class. And so that's sort of one of the mistakes I think people may be making right now with that assumption. I think digging and thinking really about the longer term changes within real estate. I mean, look, in the U.S. we've had underlying trends that have been going on for some time, and again they've been accelerated over the last 3 years. Over the last 2 years, but it's demographic changes, people moving generally from north to south, from higher tax areas to lower tax areas. Post-COVID, you have the move from higher density to lower density, and those are statistically important and significant moves that will have an impact on how people live, how people work, where people work, and the recovery to pre-pandemic levels in some segments, in some areas, may be a very, very long process.
Okay, good. We've got several questions coming through here, so I'm just reading them off for you. One of the questions that came through is on opportunities in Europe. Seeing that you look at that, are you seeing opportunities in Europe versus the U.S., and how do you assess the market dynamics between the two as you think about allocating capital?
Yeah. Look, I love this question because there's a general perception, when I speak to investors, that Europe, Western Europe in particular, and North America are fairly correlated, and I think the reality is very different. And 2020 was a great example of that. We had, and frankly, early 2021, we had same crisis, different political and social response, different economic approach to supporting assets and companies, and as a result, different demand for capital. In 2020, our activity on the liquid credit platform was almost entirely focused in North America. That's where the capital need was recognized faster, and companies needed to adjust. Fast forward to the last 3 or 4 months, our pipeline has meaningfully shifted into Europe as sort of the lingering effects of the crisis, the unfortunate relapse into lockdowns, et cetera, is is creating, the need, and patience is running out for some capital solutions. So the two markets, in my experience over the years, have different, value proposition in different times. I'm looking at some stats here right now. In 2019, in the liquid credit platform, we invested, I would say close to 50% in Europe. Then in 2020 was very little. And then I do expect Europe to be actually a very interesting area where the transitional investing, the premium for transition and complexity is going to be real.
Okay, so more exposure to Europe this year than last year for sure, given the opportunities.
Sure.
Next question.
Right.
Okay, I'm reading off the next question. It says here, there's a narrative right now as real estate's becoming a true surrogate for fixed income. Have you seen new capital buckets entering real estate that were not previously active?
Capital, particularly in liquid credit, and I'll speak from that vantage point. Capital formation is typically in liquid credit is much slower than demand for that capital. Certainly, we have seen capital formed around. We talked a little bit about expectations for distress that probably came, frankly, in an inverse way, a little earlier than distress is materializing. There certainly probably is more interest from an investor's perspective to go into real estate with a focus on getting the premium to what traditional, I would say, credit markets are offering. I don't have the data to answer whether this is more pronounced and than it was before, or than what one should have expected for this market. But I do certainly think that real estate in this environment does offer a premium for the traditional sort of fixed income markets, as well as more traditional senior lending into real estate. So I would not be surprised to see that capital is attracted to that area.
Okay, good. Alex, I have actually several questions here in the Q&A box, but they're all leading to the same thing here, which is people looking for your opinion on what regions in the world offer the best prospects for real estate investment. And I know you're more of a credit guy than an equities guy. I feel like these questions are centered around that, just giving us some insights based on your experience on where, from a macro perspective, you think there's better opportunities to invest from here. So if you don't mind giving that a go as well.
Yeah, no, sure. Look, I'll qualify this. Carlyle is a global investment firm. We have focused historically our efforts in illiquid credit and real estate credit into North America and Europe. So I will focus my opinion sort of on these two markets. But broadly starting, I think value from my perspective typically is to be had outside of the major congestion zones for capital. And capital in market dislocation tends to flow to senior debt, it's very senior in the capital structure, in very clean assets, clean businesses that people do not have to answer the question, is it a transitional risk or is this a fundamental structural change? So by default then, if you go outside of those markets, that's where I do think you can find better value. From a geographic perspective, I think you similarly look for areas of dislocation then. Europe this year and probably in the near future offers a very interesting case study of dislocation. You've had the conversion of how COVID and post-COVID pandemic environment is going to be resolved. It's still ongoing, clearly. You have the issues of Brexit and the changes that are happening associated with that. And before COVID, one of the most attractive places to invest may have been Eastern Europe. So how does that change in the aftermath of COVID? It's quite interesting. Does Eastern Europe continue to follow the path of valuation convergence, cap rate convergence, which has been a main theme in Eastern Europe before? So look, I do think European markets, just by the way they're set up right now and what's going on, probably offer opportunity for more. There's more dislocation, more uncertainty, and there's more opportunity for extracting value.
Excellent. We're coming up to close to 45 minutes here, and I just 40 minutes, and I want to make sure we wrap up with a couple more questions here. Subsectors, just following on the question. So you like Europe versus the US. Any thoughts on subsectors within, be they office, resi, student housing, industrial? That question came through both on Europe and the US, by the way. I got a couple questions on those.
Yeah, look, I'll do the cop-out answer here. Obviously, you want to invest in areas that have supportive trends. And in today's market, those trends are supportive in residential, in industrial, and logistics. And maybe as the economy starts to recover post-COVID, you'll have supporting trends in hospitality and leisure travel. Now, of course, that means that most investors also want to gravitate to those areas and avoid the pitfalls and the risks of office and retail, and making a strong bet on post-pandemic work habits of people. So for me, the best value can be found in the first three areas where clearly demand is supportive and trends are supportive. However, finding the opportunities that have complexity in it that typically prevents the regular way investor to go there. So that's why, Hani, you and I talked a lot, and we've been talking over the years about the more niche asset classes that are not on the radar of everyone, that are in the midst of a supportive market environment. However, they don't neatly slot into one or the other. There is not a lot of comps or precedents or valuation metrics. And as a result, regular way investors shy away from that. So in general, what I would be, look at North America is a good market as well. I think there's more dislocation in Europe, favoring the overall assets of residential, industrial logistics, hospitality as we start to recover, hospitality and leisure, but really focusing on finding that complexity in those niche assets within those areas that others are unwilling to tackle.
Excellent. Very illuminating, Alex. Thank you for sharing your thoughts. Maybe one last question before we wrap up, and this also came through towards the end, is more on sort of how you're observing things in New York, any changes in behavior, particularly for office workers. And given sort of the comments that came out of Google, Facebook last week, I believe that they're asking their employees to get back in the office sooner rather than later, which is quite different to where we were at the beginning of the pandemic. Any thoughts or observations from your experiences?
Look, this is going to be just personal observations, clearly not statistically significant, but there is clearly a fatigue. The pandemic is not over yet. The fatigue, and I read this somewhere that we are over it. The fatigue about working from home, working remotely constantly, which limits sort of the separation from work and life, is becoming more real. And certainly we're hearing a lot more voices about it's time to try and figure out how to get back to the office safely. So that narrative, that storyline is certainly taking significant hold right now. With that said, I do believe that the last 12 months have taught professionals and businesses out there that there is certainly efficiency in remote work environment that is beneficial to both businesses and individual employees who are looking for some more flexibility in whether it's location or work-life balance. So I do think that the ultimate resolution is going to be some form of a hybrid. And I think that's what makes prediction for office markets a little challenging, because certain industries, I think, are going to evolve into some of a hybrid model of a remote and in person. And the outcome of that is still to be seen.
Excellent. Alex, we're coming up to 45 minutes. I want to thank you so much for your insights and your thoughtful remarks. Looking forward to our next webinar and many other discussions offline on the real estate credit market. Very much appreciate your participation. And this will be the end of the webinar. For those of you that need a recording, there will be one available on our website shortly. Thank you so much, Alex. I look forward to speaking with you shortly.
Danny. Thank you, everyone, for your time and attention here.